Now, we're going to have a discussion on what's called the simulated CD approach. This is a form of a covered call position, standard buy rate, buying stock and selling a call against it. However, there's some subtle differences that we look at in what we call the simulated CD approach. Patrick sent us an email earlier this week, and he says, I did my first simulated CD this week, but in addition to the videos, could you summarize potential trades if the stock drops 10 to 20%, stays static from the entry price, or gains 10% or more prior to expiration? Also, choices as the call approaches expiration. I'm excited about a new type of trade for me. Well, what is this simulated CD approach? As I mentioned, it's just a covered call approach. It's a default search that we have on the PowerOptions covered call screen. But we use a far out in time, typically about a 1 year out call option to sell against the stock rather than selling weekly or monthly. And we're going in the money below the current stock price with this 1 year out call for higher downside protection, higher potential double-digit returns, a higher probability of being assigned and getting that return. And it is near close to what we might call a fire and forget position, almost. Management is always possible. Management might always be necessary, hence Patrick's question that came in. A live simulated CD example. Right before the webinar, I ran the simulated CD search on PowerOptions. Don't worry, we're going to take a look at this specific trade a little bit more in depth to help with Patrick's questions. We have two positions. Let's take a look at the Shopify position that came up today. Shopify is currently at 103.31. We buy shares of stock, and then we could sell the 85 strike call. Deep in the money, a little bit more than 15% in the money, and it has a midpoint price of about 31.10, 31.05. It's really 31.08 here at the midpoint price. If I entered this covered call, we'd have a downside protection of 30.1% with the potential return, if assigned, of 17.7% for this position. So yes, we do pay 103.29 for the stock. We're going to get about 31.18 here for the call. It fluctuated from when I ran the search to when I linked to the profit and loss chart. My apologies. But let's say we get 31.18 here at 103.29 for the stock. That takes your cost basis down to 72.12. That's that 30.1% downside protection. Between now and 364 days from now, Shopify could fall to 72.2% before you're at risk of losing money at the expiration, which I mentioned. We'll see that in a moment. But yes, during the time frame, because we're not getting as much time decay on the call, we could be out of loss as the stock's falling because the buyback cost is still pretty high. But what do we get? The potential here for almost an 18% return. That's using that 31.18 price and the 103.29 with still the 30% downside protection. Naturally, since this is a 1 year out trade, your annualized return is equal to the static return at expiration of 17.9%, as long as the stock remains anywhere above 85 in 364 days. That's what the simulated CD is. That's why we kind of mention its potential to be one of those fire and forget trades. 30% downside protection, potential for almost an 18% return in 365 days. Don't even have to really watch it unless the stock does fall 20, 25, maybe 30%, anywhere between now and January of 2026. But of course, you could always manage it in between, depending on what happens. My reply to Patrick's initial emails, I'll address your question, which we're doing now. Really, the simulated CD approach is designed to be relatively close to a fire and forget trade. If the stock falls 10 to 20%, you might not even be at the expiration break even. Your position might be at a small loss, but you might not be at that expiration break even yet. If you think the stock's going to recover, you might not need to manage. Now, if the stock stagnates, your call is still deep in the money and you're just waiting out the trade. The time value is still going to be relatively high. You're waiting for that to decay or to get assigned as you get closer to the expiration date. If the stock rises 10%, is doing what you want, you're waiting to be assigned for the targeted return. You'll start to lose time value / extrinsic value, and your option will be going closer to the intrinsic value, of course, and you could roll or adjust the position, the same as you would with any covered call. But the management earlier on is more difficult. if the stock did fall that 15% in the first 30 to 40 days, or it only moved up a few percent, 1 or 2% in the first 60 to 70 days, because your call is not experiencing the time decay due to the extended time frame. In other words, you're paying a fair amount to still buy to close that initial call you sold to look for another opportunity, whether in the same expiration naturally with a different strike, or a further out expiration, or maybe even a closer in expiration as well. All right. Now, why did I mention time decay and the time value 3 times in my answer? Well, what we focus on here is the time decay curve of an option. And what you typically see is naturally you have that lower time decay between 120 to 90 days out than you do from 90 days to 60. And then from 60 to 30, you see a higher percentage time decay on your option. And the last 30 days, and really the last 8 to 10 days, is when that time value really starts to decay out. We're talking about options that are 364 days away mostly with a simulated CD screen. They could be 180, but we're over here at 364. We're seeing little to no time decay. Now, we have a lot of intrinsic value in this option. That gave us that high downside protection. But we're seeing very little decay here until we start getting into these time frames, maybe 100, 90, 80, 75 days out in time before we start to see a real percentage time decay with that security. And why is that important? Because, well, if I have to roll or adjust the position to try to look for more profit or try to do another range, as you would with any covered call, you're still paying back into a fair amount of the time value collected. The intrinsic value is giving you the protection, that deep in the money value. But the extrinsic value or the time value is that profit, that 17% profit, but it's not decaying as rapidly. So you're still maybe paying back into 14, 15% time value, only realizing 1 or 2 or 3% of time premium if it's in the first 30 to 60, possibly even the first 90 days of the trade. Now, let's take a deeper look, of course. We're going to see the expected values of the Shopify position at different times and expirations. You can do that on PowerOptions. We're going to use that exact example we just showed that was run today with the simulated CD search. You can use the profit and loss chart custom spread tool to evaluate some quick what-if scenarios. Now I did a historical search for simulated CDs from last July, trying to focus on 1 year out trades only if available. Why? Because now those trades using the history are only 6 months to expiration. We've gone half the year and we have 6 months to June or July expiration. So let's see where those positions stand. And yes, I did choose one where the stock was up about 15 to 20%, I believe, and one where the stock was down about 15 to 20%. And we're going to look at that in the portfolio tools, those 2 positions that match that criteria, that historical criteria. And we're going to see what rollouts might be suggested in the portfolio tools for those trades. All that being said, what do we have to do? Hey, let's navigate over to PowerOptions. We're going to take a look at those concepts and ideas I just mentioned. All right, so here we are at the PowerOptions suite of tools. We're going to start first, excuse me, folks, by analyzing that Shopify trade that came up. We're not going to look at the stock chart and analyze it in that fashion. We're going to use the custom spread profit and loss chart to evaluate some what-if scenarios. So I'm going to go to covered call, then we're going to go to search. And here I have the monthly picks of the day up on my default webinar account. So we're just going to scroll below the list of trades in the search, go to the default searches, and select simulated CDs. It runs for me automatically, and of course, Shopify didn't come up in the top results. Must have had an update between now and when I ran the search. That's all right. Let's see if it's here. Instead of going to page 2 or page 3, I'm going to go into fundamentals, and I'm going to search by symbol. I'm going to search by SHOP. It should still be in here. It couldn't have changed that much. Really? All right. Well, I don't know what happened there. That's very odd, but that was the search. It's okay. It's fine because we have the screen here. Let's just go back and we're just going to enter it manually into the custom spread tool to look at the Shopify position that did come up right before the close of the day. So we had Shopify on the simulated CD search. We're just going to buy 100 shares, and the price from our previous screenshot was 103.31. 103.29 is what the profit and loss chart showed us when we linked over to it during that change. That's fine. And we were going to sell the 2026, January 16, 85 call. And our original one showed us the midpoint price of 31.18. All right, so there's that 17.9% return. We've got that 30% downside protection into the position. Now, Patrick, when you asked the main part, one of the parts of your email, I'm sorry, that you asked was the 3 scenarios. Could you summarize potential trades if the stock drops 10 to 20%? Well, again, I have a 30% downside protection. I'm probably not too concerned with rolling the position at that time. I still have time. Now, why did it fall, though? You ask yourself, just as you would in any other situation, Patrick, your stock fell 10 to 20%. Was it in the first 30 days? Was it in the first 60 days? Let's just put that this does drop, 11 points. Okay, let's say it drops down to $92 per share. And this happens not halfway between now and expiration. Let's do it a little bit sooner. Say it happens about 90 days out, April 17th. All right, we're 3 months into the trade. Shopify drops that 11% down to about $92. I'm sorry, about 10% or so, 11% down to $92 per share. You've only profited 1/3 of the call premium. Now, this is assuming that volatility has stayed the same. If the stock dropped 10 or 15% in the next 90 days, this might have gone up a little bit. You can estimate that, but you don't really have to. Now, what I mean is, even here with the stock falling down to 92, yes, you're losing some intrinsic value, but you still have 2,031 theoretical, of course, based on the Black-Scholes pricing model. That would be your buyback cost. So you've only made $1,000 in the first position, which, by the way, is still 7 points in the money. It's still about 9% in the money. 8% in the money, 7.5%, 8% in the money from 92 to 85. I know that's a concern because we just had a big decline of 11 or 12% or so. But again, that's what to expect. What about that 185 days out in time? Would I take action at this point 90 days in? No. If the stock starts to get closer to 85, yeah, I know it's relatively close. It's still 7 points away. But if it drops down and gets to 88 or so, maybe 87, then I might consider doing an adjustment. All right, but let's go halfway out. Let's go to 184, 185 days, the default that came up. See, now you haven't even made half yet. The stock's down to 92. So halfway into the trade, stock's been fluctuating. It's down to 92 at this point. You've only made half of what you expected. Could I roll down to a January 80 or a January 75 call just as you could with any covered call? Yes. Could you roll further out in time to get a little bit more protection? You're now a little bit nervous on this position. Yes. You have a small profit of $281, which is only about about 1/5 of what you expected to make on the trade, right, if you liquidate it. So you probably wouldn't liquidate. You could still roll or adjust, but your call hasn't made 50% yet, even halfway into the trade with stock down 10, 11%. So that's sort of the advantage of this. Again, I'm not saying it is, but it's more along the lines of doing less activity and less adjusting, more of a fire and forget trade. The stock stays static. Let's stay at the halfway point here. The stock stays static at 103.31. Where would we be? You've only gained 580. Okay, let's call it $600. 1/5 of your call premium you've only gained in time decay. That's how slow it is with a time decay curve. You're still paying $2,500 if you wanted to roll this at this point because you've only made 580 again, which is, 50% of the maximum profit you expected on the position halfway through. A little bit less than 50%, but close to it. Kind of close to it. So, where's the balance there in that case? Still, I don't think it's enough, and it's stagnating. Now, let's just be fair. 90 days, how much would you expect to see? So we're talking about 90 days into the trade, not 90 days to expiration. Stock stagnates. You've only made about $260. In that extra 95 days, you only made another $220 roughly. I'm sorry, it was $320. Sorry about that, $320 or so, because it was at $580. Okay, so you've only lost about $264 in decay. In 90 days, stock stagnating. Now, the opposite direction. We go up 10, 11%. We go up to 115, let's just call it 116, something like that. Let's call it 115. The shorter term one, since we already got it selected, 90 days out, your call is increased in value, but your stock is increased in value at a profit of $494. It's pretty close to, not quite a third yet, above a third, not quite half of the max profit you expected. Again, this is based on theoretical prices. If volatility changed, if volatility dropped, you'd see a different price here. And that would be in your favor, of course, as the stock's moving up. And if we go up to 115, 185 days out, remember this would be the halfway point for this whole trade that's out to January of 2026, you're at 785. You're a little bit more than 50%. The call only moved up $400, so that costs you that to buy back. You've got the 1171 gain here, so that puts you at 785, which is pretty close to 2/3, a little bit above 2/3, I'd say, of the $1,300 or 17% maximum profit. So halfway in, with the stock moving up, that's in your favor. Naturally, it's a neutral to bullish position. That's in your favor. So could you close it early? Of course you could. Could you roll it up at this point? Of course you could. But let's take a look at those actual positions instead of trying to simulate what all the other options would be on this trade right now. But that's how you do it, Patrick, on Power Options, to simulate what would I expect my trade to be if it moves up 10 to 20% in the first 90 days, 1/3 roughly of the total, 1/4 of the total position you're going to be in. At the halfway point, which comes up by default, where would my position be if it drops 10 to 20%, stays at the same price, or gains 10%? And then you could kind of gauge what your profit would be, and does that help you develop a trading plan? Sure, you could say, yeah, most of the time it looks like I'm going to be at more than a 50, almost 60% of the maximum profit I expected to make if the stock does move up 10 or 11% in the first 6 months. Maybe I just want to take that off the table and open a new trade. That's an approach you could use. Or you could roll it. Or you could just wait for the next 6 months to get the remaining $500 or so of the maximum profit you'd expect. Of course, you're leaving yourself open for other fluctuations in the market at that point. You to be analyzing the position new at that point anyway in the real world based on what market conditions are. Now, let's go to the portfolio where we track our open positions. We created one for simulated CDs today, and based on that historical search I mentioned, I have 2 stocks for you. CCL, this was found on both of these were found on July 22nd, 2024. I entered the wrong date here. It was July 22nd, 2024 because I saw the June expiration. One came up with a June expiration date, which is now only 154 days out in time. And the other one did find the July on Semiconductor, which is 182 days still out in time. We're at the halfway point. Carnival is up 40% from its original purchase price. The original max expected return was 14.3%, and we're pretty much 85% there at a 10.3% liquidation value. We close the position right now. The call has gone from $5.30, it's doubled in price up to $11.38. But again, we've dropped we've lost 608, on the call. We've gained 743 on the stock itself. So the profit is only at 136, but that's 10.3% of my total cost basis of 1312. Sorry, I didn't go through that. Carnival at 1842 on July 22nd, 2024 could have sold June 15th call for 530. And so we take a look at that profit and loss chart. Max return was 14.3%. The annualized return, well, it's only 34 because we're at the halfway point at this time. But again, a position where we bought the stock at 18 and we went $3 in the money to the 15 strike call. So we're still that good deep range in the money, good probability of being assigned. We'll see that later. And the break even's down to 1312. And of course, the stock's up at 25.85. That's that 40% movement. So we could liquidate right now and take pretty much 65% of the max return we expected with a 10.3% return. Could we roll in this position? Of course we could. How do we do that? Again, back in the portfolio, we're going to go to position actions, position analysis. This gives us a breakdown of our current position. The deltas, there's still 2% of time value remaining on our option, with 185 days left. And remember, we're in the 15 strike, and the stock's at 25.85. Right, we're 10 points and 85 cents in the money, and the buyback cost is 11.38. I know it's small. We're looking at a smaller price stock here. We still have 2% of time value remaining, even being that deep in the money, because we're still 5.5, 6 months out to expiration, the time value decay. Now, remember, the expected return is 14.3%, which means the return on that covered call is the time premium. That 14.3% is what you initially collected. It's only down to 2% now. So you've made essentially close to that 10%. That's what we're looking at. 10.3%, 72% of the income you've made so far. In other words, if you liquidate right now, you're making 72% of the max return you'd expect to make in the next 5 months or so to June expiration if the stock stays above that price. Why is it important to know this? Where am I right now? 10.3% at liquidation, 14.3% in 5 months. Could I roll this position? Yeah, this one's just showing me standard rolls up to the June 17 strike call, which does what? Keeps that same 5 months out in time. I have to pay $11.38 to buy this back, and the new midpoint is $9.68. So with the initial net credit of $5.30, my adjusted net credit is $3.60, but to be assigned at 17. Now, I still have 19.5% downside protection for the next 5 months, but I only move the needle from 14.3 to 14.7%. I don't know if that's really worth it. The downside protection is still strong, of course. We're only moving up by 0.4%. Hey, it's 0.4% we didn't have yesterday. But again, would I do that? Would you look to roll out a year right now to try to see if you can get another 5 or 6% and move the max return up to 19 or 20% for an additional 6 months? Of course you could if it was available, if those options are available for this particular stock, which I think they are. But that's the idea. Where am I right now? I'm at a place where I can liquidate and make 72% of what I expected to make in the first 6 months of the trade. I may be tempted to take that off the table and then run a search and look for new ones. I could evaluate other rollout opportunities manually using the custom spread tool as well. But I'm in the proper position. It's doing what I wanted. My choice is liquidate now, take 72% of the profit 6 months early, stay in the position, look for the maximum return of 14, or do nothing as well. In this case, I'd probably be leaning towards liquidating, but that's going to depend on your trading plan for this strategy, Patrick, in your portfolio. The loser on semiconductor on July 22nd, 2024, could have bought shares of stock at $77.33 and sold the July 2025, 1 year out in time, 55 strike call, 22 points in the money on a $77 stock for $27.95. Stock has fallen 29.4%. This call has pretty much covered most of that loss, right? The stock's down 22.70 or 29.4%. We've made $2,000 on the call because it's now trading at $7.73. So we've made 72.4% on the call. Original return 11.4%, but right now we're at a 5% loss on the trade as well. Now, okay, let's take a look just quickly at the profit and loss chart just to see the bird's eye view. We can see that on the position analysis too, but that's what we've got with on. The stock is still above our call strike. Oh, it's just below. I'm sorry. It's just below our call strike price now at 54.63. It moved up 112 today. So we're in that loss of 5. Halfway through the trade, 5%, about $248. Maximum profit was $562, or 11.4%. Okay, so should we roll or adjust this position? Yeah, you've probably been panicking before if it's been down, I think, as low as 51 or maybe even 49. over the course of the year. But let's go ahead and take a look again. Position actions, tracking the position in the portfolio, position analysis. Time value is still 14%, but we're talking about that smaller percentages. And we're down at a liquidation loss of 5% right now. But if the stock stays where it is in the next 182 days, meaning it stays even below our strike price at 54.65, 54.50, we'd still make a profit of 10.6% when all the remaining time value is out of that call, it expires worthless, and we could close the stock. We'd still have a small profit, 10.6%. But again, this one here doesn't show any rollout opportunities because we're pretty much right at the money with 6 months to go. In the background, what is looking at the different basic rules we would look for to roll or adjust the covered call position. And this one isn't too bad, but sure, I could roll down to the July 50 strike if it gives me what I want. I'd use the profit and loss chart to simulate that. There's help videos on the profit and loss chart how to do that, and you've seen me do that in other webinars as well. But again, this is the idea, looking at the positions of what we might consider to roll or adjust. That's how we would do it. Right now, I don't think I would roll this position unless you felt it was going to continue to fall. It looks like it might have bottomed out and is starting showing some profit. It's been moving back up. All the semiconductors have. We talked about this last week, actually, the week before. A lot of the MU stock, TWS, Taiwan Semiconductor, and others got a real big boost from a positive competitor in their same industry and sector. And the rising boat just lifted all tides. And I think ON Semiconductor is in the same group now. They're getting more and more. They've been depressed all last year. I'm sorry, most of these stocks were down, I think, 15, 20, 25%. 29.4% from ON Semiconductors just from 6 months ago, from July 22nd, 2024. So I'm in a good position, though. I'm at a loss. I could manage this position. Could roll the position. If I wanted to, that'd be perfectly fine. Now, the overall portfolio is showing a loss, and that's only because I didn't do proper sizing in this case, Patrick, meaning that I should have done, I'm sorry, what was the cost here? 13 here. I should have done 400 shares. No, I should have done 300 shares here, or maybe 200 shares of ON and 600 shares here to keep the money the same. So you'd see about a 5.3% profit. Equal entry into each. I didn't. To keep the math simple and the graph simple, we just used 100 shares and one call. Okay? So that's what you'd see if I had done the proper money assignment for this example, but I didn't, just to keep the graph simple. Can you roll and adjust? Yes. Will the profit and loss portfolio tools, show you potential rollout opportunities that are there? Yes, they will if they're available. The idea is based on what trading plan you develop. When you go back and you run your what-if scenarios on the custom spread tool to what happens if my stock stayed static for the first 90 days or 6 months, if it dropped 10, 15, 20% in the first 90 days or 6 months. You can use 60 days too. That's up to you how you want to analyze it. Or if the stock moves up 10 or 12%, and use that as a basis. Hey, would I liquidate? Would I get out of the position to stop further losses? But hey, down 30%, as we saw on Semiconductor, you're only losing 5%, and the stock's trading right at the call strike price with 6 months to go. I don't know if I want to maybe adjust that right now. It's going to depend on what my thoughts are there for the market going forward. But again, let's take a look here while we're talking about that. I'm going to pause the screen very quickly. I'm going to navigate back over to our slides. There, just have a couple more slides to share with you. And so let's just talk about that too. What rollouts might be essential. We reviewed all that. Now, how did those other simulated CDs? There was a total of about 12, I think. 17. There it is, 17 results. This was the criteria from July 22nd, 2024, as I mentioned. There's the CCL position that came up on the historical search for simulated CDs. No changes, just the same simulated CDs, July 22nd, 2024. I'm sorry, I'm lying. I made a change to the expiration. I forced it to be between 270 and 370 days out in time. That's why we got that April one in there, the June one I mentioned for Carnival that we just looked at. And then you see the full July ones. No, most of these are the June ones. I apologize. In any case, sorry about that. Oh, there's the July one, App Loving. Okay, there was another UA. We looked at the other one. But These are the top 17 results. You see the R's in there, the Carnival one, the On Semiconductor one. Schlumberger was in there. They just had earnings today. Didn't do too much, up, 1.5%, 2.5%. But when you run a historical search, you can then hit calculate group results to see the end return of those positions. We are not at the end return, right? We're not there. We're at halfway point. But that same search results from July 22nd, 2024. 78% of the positions were profitable for an average of a 4.6% return. Lagging QQQ and SPX, but you expect that because of the capped gains on the position, even though we're looking at double-digit gains. But what haven't we seen? Here's the key. The app-loving position at 83.24 with a July 67.5 strike in the money, naturally. 33% downside protection, 22% if assigned. The stocks moved up from 83.24 to 342.34. So we're pretty much at full profit, but notice we're not there yet. This thing is so ridiculously 80% in the money, so ridiculously far in the money. But we still have what? We're missing 2% of our return. It's still holding 2% of time value halfway into the trade, even being that deep in the money. That's that time decay we were talking about with using this far out structure. Celestica, 56.90, April 47.5 call. At 16.15, 28% downside, 17 almost, 16.6% return. Stock's doubled. It's up to 113.28. We're still 2% shy of the maximum profit because we still have 6 months to go to expiration. Okay, April, I'm sorry. We have 3 months to go to expiration. Max return, here's the Carnival, 14.3. We looked at that one in depth. We're only at a 10.3% return. The stock's at 25.85, and we're holding the 15 strike. Still need a little bit more time decay here, although we could roll the position. We talked about that. But we're not seeing full profit yet because of the time value curve. We're still over here in most of these scenarios, not down here. All right, where's the big one? There it is. Top Golf, Callaway Brands, 15.52 is one of those lower price stocks again. The 12.5 strike. 28.4% downside protection, cost of $440, 12.4% return. Good for a 1 year out return, not great. But stock's fallen to 806. It's dropped 50%. And we're at a 28.9% loss, meaning what? We crossed the threshold of the downside protection we've had, and now we're taking loss on a stock that's down about 50%. Okay, so hedged, A-okay. And then there's an On Semiconductor, which, we saw we had the 55 strike. It's down to 54.64, but we're only at a loss of about 3.8%, 5% on the position. This was before the last run of the day when I ran these the historical screen. So it's basing it off of today's prices on 117. All right. And of course, some of the other ones, Floor, here's one that stayed stable. 48.56, June 40 strike call at 12.60, 26% downside, 11.2% return if assigned. Waffling, stock's at 50.39. We've got a 3.7% return of the 11.2% expected. We're still in the money. We've still got a good downside protection. We're still 20.6% in the money in this case. So we're still looking good there. But we haven't realized the full return or even half of the return halfway through the trade. The stock hasn't moved. Same with Schlumberger, 49.44. It actually took a hit, didn't it? It dropped. I'm sorry, 43.58. We're at a 1.7% gain. So still with a drop of 6 points. Roughly about 12 for a 15% decline. You're still at a small profit of 1.7%. And you're still in the money on the trade. But you're nowhere near half. Not too far away. This is only a 6.5% return. So you might have not even done Schlumberger because the point is to look for a double-digit return in that case. But those ones we use from the example to see where the top, a high gainer and a high loser relatively would stand and what rollouts you could use, Patrick. That came from this specific search from July 22nd. It says user defined. It was the simulated CD default criteria. I just changed the expiration date to force it to be closer to a year for our example so we could see we were halfway through. So Patrick, I hope that helps answer your question. I hope that gives you some insight into what you wanted to see related to more on the simulated CDs. And remember, of course, there's a lot of other content that you can view and take a look at related to the simulated CD approach. Does the simulated CD approach work the same way? If I did it with, say, a cash secured naked put, well, hey, just go to our YouTube channel, use that magnifying glass to search, and just go simulated CD. And best ways to search for simulated CDs part 2, cash secured parity cash secured put, far out in time simulated CD versus shorter term. And we just did a recent presentation. There it is, low maintenance trading, or the fire and forget trades to earn 20 to 30% per year, part 1. We didn't quite see 20 to 30% yet on those positions we evaluated. There were some on the searches that offered that, both the live search today and the historical screen. One was close to it. That app loving, which is, went from $83.24 to $342 in 2 months in that case. But those are some of the concepts, the part 1. This is not really part 2 of that. That's going to be a different comparison. But this will give you some more insight into that simulated series, deeper look into the search tool, into the parity trade, basic versus shorter term. Initial one, covered call approach, far out in time, high return, and so forth as well. So follow up to covered call approach, far out in time, high return and protection. Other information on that simulated CD concept, ideas and difference, but I think we've covered the management concept here, as well as what you might want to look for and how, Patrick, you can run your own what-if scenarios and evaluations based on what you're concerned about to help you develop your trading plan.